So you want to make money shorting volatility because you know that those volatility ETPs like VXX and UVXY, they do decay downward over time, right? If we could just find ways to capitalize on this, we'd be golden. But the problem is there's many different ways to short volatility. Should we be shorting the volatility ETPs directly? Should we be buying out of the money put options or maybe vertical spreads? What about butterflies, iron condors, straddles, diagonals, naked calls? No, don't do that one. In today's video, we're going to break down the main advantages and disadvantages of 5 different methods of shorting the VXX. These are live trades head to head, and we're going to try to figure out which one has the best risk-reward ratio. And comment down below, what's your favorite method of shorting volatility? Let's see if it matches up with what I'm going to talk about today. So you already know in the last video I published on YouTube, I'll leave a link for that here if you haven't seen it, I executed 5 different live short VXX trades in the Thinkorswim trading platform. The first one was just so we can have a good baseline for comparison, and it's shorting the VXX shares directly. The second trade was a basic long put option, probably something all of you have traded at some point. The third, again, is a very common way of shorting volatility, and that was a long put vertical spread. The fourth, and one we use a lot in our VTS volatility trend strategy, for example, is a long put butterfly spread. And then lastly, just so we can get some naked options exposure, we did a short straddle. 5 trades, 5 different risk reward profiles, and today we're going to talk about the advantages and disadvantages of all of them. Let's start with a straight up short VXX position, because when people think about shorting volatility, in a lot of cases this is the one they default to. So you can see the risk profile here, and it is a direct one-to-one relationship to the price of the VXX. If it goes down $1, then you make $1, and if it goes up $1, then you lose $1. This is the most direct way to short volatility. Unfortunately, it's also one of the riskiest, and this is not a trade that I ever use in my own portfolio. I could talk all day long about the disadvantages of why you should never use these, but let's talk about one advantage that it does have. When you short the VXX directly, you're not subject to any of the option Greeks at all. So Delta, Theta, Vega, all of these affect all of the other trades we're going to talk about today. But short VXX positions aren't options. This makes this trade very easy, and you don't have to worry about the level of volatility in the market. If you think the VXX is going down, well, you can just short those shares. But there are many disadvantages here. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVXY. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? It makes no sense, so please understand it's a terrible idea to short the volatility ETPs directly. There's one advantage and many disadvantages, just don't do it. The second trade we opened is this one. It's a long VXX put option at the 27 strike. So you can see the VXX right now is around 36, and we need it to go down this way to make our profit. So the first thing that we'll talk about here is that long put options have the potential for much higher profit if the trader gets the timing right. Now, easier said than done, but you can see here this trade cost $1,140 to open. And if VXX decays more than usual, this trade could double or even triple its money. Another advantage we can highlight here, if we look at what's called Vega, you can see this is a positive number. Long put options are Vega positive. Now, really quickly, Vega is the option Greek representing volatility. Vega shows how an option's value will change given a 1% change in volatility. The Vega of this long put option is positive, and that means that if volatility goes up, this trade will gain some value from that. So if we go back to the original trade, the reason I'm listing this as an advantage is that if volatility spikes up this way, this is bad for a short volatility trade, and this will lose money. However, because it's Vega positive, that rise in volatility will actually mitigate some of the losses. Now, not enough, and it'll still be a losing trade, but you do have a small margin for error there, and losses pile up a little bit slower than if the trade was Vega negative. But now let's talk about the 2 main disadvantages here, and these are big ones. First, with long put options, you have to nail your directional prediction perfectly. This trade costs a premium to open it, meaning you have to get the direction right and you have to overcome that upfront premium. With VXX around 36 right now, it has to go all the way down to about $23 just to break even at expiration. That's a massive upfront cost to overcome, and you have to be directionally right in a big way. The second disadvantage is the option Greek theta, which refers to time decay. Theta shows how an option's value will change given the passage of one day. If we check out the theta of a long put option, now we can see this is a negative number. Now, it may not seem like much initially, but this ramps up exponentially as you get closer to expiration. Long puts are strongly theta negative, and it means they will be bleeding capital every day that goes by. So while there are some advantages to long put options, the disadvantages far outweigh those. It's expensive upfront and it's theta negative, which means not only do you have to get the direction right in a big way, but it also has to happen sooner rather than later. Basically, you have to nail your trade exactly right, and it's just not possible to consistently time the market like that. The third trade we have open is a long VXX vertical put spread. So again, the VXX is trading around here, and we need it to go downwards to make our profit. This is short volatility. The first big advantage to this trade, if you'll notice, we're using two different strikes here for a vertical. The 29 strike is a long option and the 24 strike is a short option. Because it's using both of them, we don't actually have to worry about the option Greeks very much here. Now, they don't cancel out completely, but it's enough to say that we can basically ignore the Greeks. It's mostly a price trade. We just want the VXX to go down. The second advantage is that we know both the maximum gain and the maximum loss for the trade the day we open it. This makes risk management easier, and we can scale these appropriately to the size of our overall portfolio. If volatility spikes in a market crash, you can see what the damage will be, and you just don't take on too much risk with each trade. This is a 3-year chart of the VXX, and what you do is just layer a whole bunch of smaller vertical put spreads over time, tracking it downwards. You'll get losing trades along the way, of course that's unavoidable, but if you keep each trade small, keep that trade frequency high, you should have more winners than losers and make a nice return long term. Now, there is one main disadvantage here, and again, a long put vertical spread is a debit spread. You are paying a premium to open the trade. And again, it means you have to quite clearly get your price prediction correct to overcome that upfront cost. No trade is perfect, of course, but vertical spreads are a good way to short the VXX. You don't really have to worry about the option Greeks, and they do have a very good risk-reward profile that you can see from the beginning. Now, you do have to nail the direction right. There's no getting around that with debit spreads. But like I said, if you keep each trade small and you just layer a whole bunch of them over time, you should be able to extract some of that VXX decay that we know is coming. The fourth trade, if you watch my videos, is a personal favorite of mine. It's a long VXX Put Butterfly spread, and it looks like this. Now, ignore the pink line. The market isn't live right now, so it's showing a bad print. But you can see the trade structure. VXX trading around 36 right now, and we want it to decay closer to this 25 range, which was our initial price prediction for the expiration of the date we chose. Now, the first advantage, again, because we're using short and long options to make these, this butterfly is two short options in the middle at the $25 strike, and then two long options on either side to cap the losses at 20 and 30. We're using both, so again, we don't really need to worry about aligning this trade with the Greeks. It's just not going to matter as much. The second advantage, and this is one that people will like, there is massive potential for profit on these butterflies. You can see I scaled the trade to about the same $1,000. That's how much it cost, and that is the maximum loss. But if I get my prediction of $25 correctly, there's potential to make many multiples of what I'm risking, as much as 5 times my money in this case. Now, it's a smaller profit range, so if you were just doing 1 or 2 of them in a year, you'd need to get pretty lucky getting expirations in that high area. But just like with verticals, the key here is to layer many small trades over time. Trying to get it right with one trade way off in the future is unlikely. But if you have 30 or 40 of these in a year, now all of a sudden you're going to be tracking the VXX downward. This is how you make your profit long term. So don't really worry about the option Greeks, and then hopefully you're also going to get some of those outsized wins from time to time that really push your profit forward. The only real disadvantage here is the same thing we've been talking about before. When you pay a debit to open an option spread, you do have to overcome that upfront premium. With directional butterflies that are out of the money, you do need the VXX to go down, otherwise you're just going to eventually lose your premium. The fifth trade we'll go over today is a short straddle option on the VXX. And for this one, there is no upfront premium to overcome like the other trades. In fact, this is a short option spread. We actually get a credit for opening this one. So let's start with that as the main advantage. The VXX is right here around 36, and our profit range is anywhere from about $42.50 all the way down to $10. This is a massive range where we can make some money, and it does mean the probability probability of success is definitely higher than 50-50. In fact, long term, you'll probably win 80% or more of your short straddles. That's how this works. You don't even need to get the direction right here. Even if the VXX doesn't go down at all, right here you can still make profit. Now, if you're looking at this max profit here and thinking, wow, that's huge potential, just remember I wasn't able to scale this to $1,000 like the other trades. One single short straddle requires over $5,000 of capital. So if we want to compare apples to apples here, we do need to divide this by 5. And that brings us to the first of several disadvantages here. Short straddles are massively capital inefficient. This is not a good risk-reward ratio at all, and it makes it difficult to have much of an impact on the rest of your investing portfolio. The second disadvantage I will highlight is this is a naked short option, which means it's very limited in what account types you can even open these in. You can't do this in any of the tax-sheltered account structures, and you're going to need the highest level of options approval in a margin account to do these. These just aren't going to apply to that many investors. The third disadvantage, and I cannot stress how big of a problem this is, short straddles are unlimited loss trades. Just like with shorting the ETF directly or selling naked calls, for example, selling short straddles means you're always going to be worried about those unexpected volatility spikes that do happen, and they will happen again. Now, some people might say, oh, that's fine, you just buy some calls and hedge the position. Yeah, hedging costs a fortune and it eats away at your potential profit. Remember, the risk reward was already skewed and there was only a small profit available anyway. You start wasting money on hedging to make the trade safer, well, now it's not even worth opening anymore. The bottom line is unlimited loss trades should always be avoided. They're capital inefficient, they're restrictive on account types, and there's no way to manage that risk without sacrificing most of your potential profit. Long term, you'll make way more money using defined risk trades. So after all that, what's the biggest takeaway today? Which one of these is the best? Well, I'm going to say there are two that are head and shoulders above the rest here. And I'm going to award the butterfly spread with the first place trophy. Very capital efficient, small maximum loss with potential for huge outsized profit. You're going to have some misses, but the VXX does decay about 5% a month long term. So remember, the key here is to layer many small trades over time. Our runner-up trophy goes to the vertical put spread, which for the same reasons is also a very good way to short volatility. Again, layer your trades and think about it in steps. In fact, one of my short volatility strategies is called the volatility step, and it uses vertical spreads. If you take advantage of the efficiency of the vertical spread trade structure, you can make a very nice long-term return without worrying about that looming flash crash. Of course, I can't tell you what to do and what not to do, but in my humble opinion, shorting the volatility ETPs directly and selling short straddles are both garbage ways to short volatility. Way too much risk and not nearly enough reward. Inefficient, restrictive, and eventually you will get caught in a volatility spike that ruins your forward progress. Defined risk is always going to be your best bet when shorting volatility. Butterflies and verticals are a great way to do it. I would recommend people stick to those. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.